Benjamin Graham wrote The Intelligent Investor, which is the most important and influential value investing book ever written. And now let's see what he has to teach us. At the beginning, you have to understand the difference between investment and speculation. Investing entails a thorough analysis of an investment that includes determining the risk and return characteristics of the asset. An investment has the ability to promise safety of principal and an adequate return. The investor's primary interest is to acquire and hold suitable securities at suitable prices. Investing is not about beating others at their game. It's about controlling yourself at your own game. Speculation, on the other hand, involves taking investment decisions that are not made on a foundation of research and analysis. Investors should limit their allocation to speculative positions to no more than 10% of the investment funds. Never mingle the money in the speculative account with the money in the investment account. Now, let's talk about Mr. Market concept. Suppose you own small shares in a business that cost you $1,000. Your partner, named Mr. Market, tells you every day what he thinks your shares are worth. Sometimes his idea of value appears justified and plausible by business developments and prospects. On the other hand, Mr. Market gets a bit too enthusiastic and values your stocks at ridiculous prices. If you are an intelligent investor, you will not let Mr. Market determine your stock's worth. Instead, you should make your own decisions based on your own research. Inflation. Cash becomes less valuable over time. For example, $1 10 years ago is worth more than $1 today. Therefore, instead of holding on to cash, we must be investing cash so we can beat inflation. Graham explains that stocks tend to outpace inflation 80% of the time. But most stocks do not react well to high levels of inflation. One investment that is safe irrespective of how high inflation becomes is REITs. REITs are real estate investment trusts. What type of investor should you be? Before choosing how you invest, you should consider the following factors. Are you single or married? Does your partner work, and how much money do they earn? Do you or will you have children? When will high costs kick in? Will you inherit money, or will you end up financially responsible for aging, ailing parents? Is your job secure? If you are self-employed, how long do businesses similar to yours tend to survive? Do you need your investments to supplement your cash income? How much money can you afford to lose on investments? The defensive investors should have a minimum of 25% of their savings in bonds. Then, a maximum of 75% of their savings in stocks. When you choose stocks as defensive investor, you should take in consideration these following things. How large is the enterprise? Choose larger and less volatile companies. Assets should be at least twice of current liabilities, and long-term debt should be less than net current assets. Positive earnings should be recorded for the past 10 years. Dividends should have been paid out without interruption for the past 20 years. The per-share earnings should have a minimum increase of at least 1/3 over the past 10 years. The price-to-earnings ratio should be no more than 15 times the average. When you choose stocks as enterprising investor, you should take in consideration these following things. The company's current assets should be at least 1.5 times current liabilities. They should not have debt that is more than 110% of net current assets. There should be no earning deficit in the last 5 years. There should be a dividend. Last year's earnings should be more than those of the year before. The price of the stock should be less than 120% of net tangible assets. Avoid day trading as it is extremely risky. IPOs are not a good investment as they are often overpriced. Treat cheap bonds with skepticism. Only buy foreign bonds if you are incredibly confident. A great company is not an excellent investment if you are overpaying for the stock. Big firms grow slower. Therefore, avoid companies with price and earnings ratios over 25 to 30. Look out for temporary unpopularity. The market quickly forgets, and this stock will probably rebound if you get it at a reasonable price. Signs that you need a financial advisor. You have suffered a significant loss of more than 40% for your portfolio. You struggle to make ends meet. Your portfolio is chaotic and not well thought out. You have just had a significant change in your life, such as retiring or becoming self-employed. The sayings that fake advisors use. This is your opportunity of a lifetime. Don't you want to be rich like me? It would be best if you focused on performance rather than my fees. You can't lose with my method. You have huge amounts of money to earn. This is a trick that only I know. You don't even need to question the legitimacy of this method.